if you're keeping the property and say you have got some credit blips, they might say, well, look, can you actually get a mortgage? Can you show us some sort of proof you can? So the exit is a key thing. How realistic is it? Is there money left in? If there is it your money or the investor's money? How does that all work? They just care about the exit strategy.
I personally listen. All the bank robbers stay away from me. I do nice, humble deals and try and make a penny. And welcome back to another episode of the Property by Kazi podcast. Each and every week, we've got an amazing guest from the property space. This week, we're joined by Shaz. Shaz, how you doing?
I'm good. Listen, I'm going to say this is long overdue, Kazi. Thanks for having me.
It's very long. Listen, I've got to think of questions out of the box. He's told me he's done 27 podcasts this year. We're going to make sure we keep it engaging, interesting. Now, you know that we film in advance, so I might be asking you some questions about how the market is now. So no pressure, but by the time people watch this, it's going to have happened.
I'll try
so your predictions have got to be on point. But yeah, I mean, when you said you've been in 27 podcasts, I was like, where do we start? Because I don't want to start on, we've got to start on the basics. So tell people just a little bit about yourself.
Of course, no thanks. So I am a mortgage broker. Mm-hmm. I have my own mortgage brokerage. We work mainly with property investors. I'll be honest, I've figured out or realized as I'm developing that my kind of niche clients are the newbies doing smaller deals. Nothing wrong with that because a lot of brokers want to do those. So smaller deals in South Wales and the Midlands. But yeah, don't do residential. It's investment finance only. That's what I do. That's what gets me the income. But what I do generally is a lot of branding, content, social media, that kind of thing.
So man, we're always looking for sponsors, man. Like, you know, if you don't ask, you don't get. But okay, so working with, what would you class as a smaller deal?
So, I mean, just to put it in context for brokers, like when I visit London and I go to see other brokers and they're checking out deal sizes, like, yeah, just did a £2 million portfolio refinance or did a £10 million development deal. Yeah, that's the average case size, and to them it's nothing. For me, average deal size sits between 75k to 200,000 pounds. Nothing wrong with that. Like, I enjoy them, and those clients come back a lot more regularly as well because they're smaller deals. I've done some as small as 37,500 as well.
Wow, I think that's interesting because one of the main things about property is barriers to entry, and there's things like credit that we have to take into account, but realistically, it's money. It's the capital to do a deal. So in terms of you helping, you know, maybe a more rookie or less seasoned, I should say, investor, talk me through like a deal where they haven't had to put a lot of money in.
Kazi, you'd be surprised. I get a lot of people coming to me with no assets, no income or very little income, no money, no experience, and they want to start their first development, right? Because that's what they are taught on social media. It's possible, but I'd say try not to be in that position because you're not that lendable, you're not that mortgageable. But yeah, we've done deals recently where you can essentially, if you've got an investor on board, they've got loan agreements, they have to sign deed of subordination, anti-money laundering checks, so it's not hands off.
So go ahead and tell people, because I think it's always good to give as much information as possible. Yeah. Sometimes in this property space, we just be like BRRI, LTV, XYZ, PBQ, Fine. Before you know it, where people are lost and switched off. So deed of subordination, like what is one of those?
So let's talk this through. So you're on social media, you're looking for, you know, you've got deals ready or you're getting deals and you pitch for an investor. Now, the investor might want to be really hands-off. Have my money, give me my return, thank you, goodbye. It's not that hands-off, unfortunately. So if you're using bridging finance, lenders are okay with having an investor, but they want to make sure that, one, that money's gone through the AML, anti-money laundering checks. So where's that money come from?
Yeah.
How long they had it? Has a solicitor checked that? That's the first thing I want to check. Then bridging lenders are very risk-averse, which is really weird because you'd think they'd want to take risks, but they make the investor sign a deed of subordination. Now, what that is a legal document to say, I'm the investor, I'm lending Kazi this money, it's unsecured, and I have no interest in this property. All it does is add to your legal costs, and it really separates the investor from the transaction. But it's one of those risk measures the investors put in place. I think it's another layer separating them from the transaction.
And it's just one of those things, like sometimes, for example, specific lenders won't allow, like they have it in their terms, you can't have a second charge, like so you can't offer that level of security. So just understanding how to work with investors. And I think, you know, social media is amazing for so many things in terms of outreach, in terms of creating credibility. But I think because it is like, it was originally Instagram was 15-second posts, now it's a minute, but even how much good information can you get across? So I think conversations like this really help people understand the nitty-gritty. So we spoke about like AML, which is the anti-money laundering. You've also got like know your client as well.
And I would say, look, even if you're not using lending or bridging, anytime you're getting money from someone, you should be doing these checks, or your solicitor should be. Don't just get money transferred to you without the checks being done.
Yeah, no, because it's all about risk mitigation and protecting yourself. You can want that money, but you need to understand where it comes from to protect yourself, because otherwise you could affect you. The reason they're in place is to stop you from being, tied into a money laundering case. If,
Imagine.
God forbid, the person you're working with didn't get the money from the right channels. I think that's really important. Have you got any, sites you can recommend or places that people can recommend to use to do anti-money laundering? I know I've got a few that I use, but have you got any?
Now, the one that we use is, what's it called now? I think it's called amlcheck.com. We use that as a brokerage. So any clients that come in, we put their ID details in, and it'll come back if they're on any like registers or banned lists or anything like that. Yeah.
So I use something called, I originally used to use Credus,
Okay.
which is like sort of quite top level. You have to just pay for a certain amount of tickets. So you'd have to quite regularly be using investors. Outside of that, there's one actually that one of the guys you've had on the podcast before set up, and it's being used by Savills, loads of top solicitors now, and it's called Checkboard, I believe.
Checkboard. Okay, I'll check that out.
And they do stuff like they not only do the AML, but you can also do like electronic proof of funds.
Really?
Because a lot of the time, if I'm the investor of £1 million and you're the guy on Instagram, I don't necessarily want to send you my bank statement.
Absolutely.
So you can do an electronic money check, which means that you can see the funds are there without having to actually send over documents, and people are scared about, data protection and things like that.
And I think that's where it's going, is technology. If you've got access to tech, use it, because it'll save you time and money.
Okay, so that's like kind of like the anti-money laundering and people protecting themselves. But as you mentioned, although it is a bridge to jump over, a bridge. Is it a bridge? No?
If
That's
you get
what I'm
lending,
saying? Yeah, a bridge.
That's what I meant.
See, that broke alone. Do a dad joke for you there. It's a hurdle. That's what I meant to say. I'm tired, man. It's possible. So then you also mentioned that potentially lenders will lend to you if you don't have an asset already. They will lend to you potentially if you don't have a certain level of income. So what is it like if you're looking at bridging? What's like the bare minimum? What do you need?
Look, with bridging finance, the most important thing lenders care about is the exit. How are you going to pay us back, and how realistic is that? So if you're going to sell the house, if it's a flip, you could have bad credit and you can still do the flip, because you don't have to have good credit to sell a house, right?
Yeah.
So that's it. If you're keeping the property and say you have got some credit blips, they might say, well, look, can you actually get a mortgage? Can you show us some sort of proof you can? So the exit is a key thing. How realistic is it? Is there money left in? If there is it your money or the investor's money? How does that all work? They just care about the exit strategy.
And in this current market, what are you finding lenders are happy with as a loan to value? Because I know at a certain point in time, bridges were getting up to sort of 80% plus sometimes. What does it look like in this current market?
It's interesting, Kazi. So with bridging, I don't think they've really felt the effects of what's going on, because a lot of it is private money. So they can just do what they want with it, really.
And can you explain the difference to private money?
Yes,
Because
I hope I get this right.
Don't understand.
Hope I get this right. So there's two types of bridging lenders. You've got principal and non-principal. Principal lenders will lend their own money, so they'll have private families who are wealthy or investors. And non-principal lenders are lending money from other banks. So they'll have like the Lloyds Bank funding them, Shawbrook just giving their funds. There's pros and cons to both. So if they're lending their own money, they can be more flexible. They can probably be quicker because it's just literally their cash sat around. Probably be a bit cheaper because they just want a return on the money. With the ones who are lending other people's money, so non-principal lenders, they have less control over their money because they've been told by Lloyds, these are your parameters, you can only do this X, Y, and Z. But you know where you stand with them. They've got a rate sheet because they've got their parameters. They won't really be flexible, but it's black and white. It's a bit more reliable. So that's the difference. I always say it's worth understanding where the funding is coming from, because you'll know how they'll be treated throughout the journey then.
Okay. And then in terms of loan to values, have you said you haven't really seen no drop?
75% still, yeah.
It's pretty standard. Okay, fair enough. And then I think one thing that I think is something that people don't always understand is the requirement difference, and also what it means from your net loan between serviced and retained interest.
Cool. Glad you asked that question. It's because it does get asked a lot. And often people are like, oh, why am I getting less money? So if we break down a loan, so on the top level, you have your gross loan, 75%. So if we say £100,000 purchase price, 75% is 75,000. That's gross. That's what you pay interest on. Now, you could choose to service the interest. So you pay the interest each month on a direct debit based on the interest rate. I'll be honest, people don't tend to do that unless you're buying like a tenanted asset at auction or something. It's a bit inconvenient to pay interest plus develop the property and so on. So it's not very common. Then you've got retained interest. So what happens is, it's the most common method. Let's say you agree a term of 12 months and the rate of interest is 1% a month. The lender works out, okay, what's 12 months worth of interest on that 75,000? and let's say it's £10,000.
Yeah.
They will retain that from the loan upfront, and your net loans is lower. Normally, it's about £65,000.
So it drops effectively. So using those rounders, they retain £10,000.
Yes.
You're
But
on
there is a but. There is a
75%.
but on this. So
Go on.
people always say, well, look, do I get a refund if I pay it back early? Well, have I paid the interest? No, you haven't. So in essence, when you pay back the loan, let's pay it back in 12 months, full term, you pay back the 75,000. If you pay it back in 6 months, you pay back your net loan plus 6 months worth of interest. The kicker, or the issue I see, is the difference between the gross loan of 75 and the net loan of, say, 65. You never see it, but you pay interest on it. The way lenders get around it or get away with it is that from an FCA perspective, it's risk management. You know, and the lender knows you're never going to be above 75% ever because they factored that in.
Okay.
But you're paying interest on money you never see.
Fair enough. But you still, wait, so you don't get any of the money back?
No. All they do is they adjust your redemption figure
Yeah.
to factor in how long you've actually had the loan for.
Yeah. So you still get the...
You don't get it back. So you're paying...
I feel like I get it back.
No,
Am I
because
bugging?
you're borrowing 75,000.
Yeah.
Or in your case, 750,000 because you're big deals only. Yeah.
I personally listen. All the bank robbers stay away from me. I do nice, humble deals and
In
try and
South
make
Wales.
a penny.
But yeah, so you're borrowing 75,000. You're paying interest on 75,000. You're only getting 65. When you pay it back, you're paying 65 plus whatever you've had it, how long you've had it for. But that difference, the 10 grand difference, you're never going to see it.
Yeah, I'm never going to see that. But again,
your redemptions are adjusted. You don't get that money back though.
Okay, fair enough. But yeah, that is the way most people do it. Reason being is because you then don't have to prove income, because if you're servicing a loan, you've then got to show affordability as well, which is an extra thing. And again, it depends on the size of the deal. And it may be okay, like for example, if you're doing deals in Wales where it's affordable. If, for example, all of a sudden you've got to justify borrowing, whether it's £500,000 or £1 million, it gets a lot more pricey, a lot quicker.
And the other thing as well is, I think just from what I say to investors is, it's positioning. So if you come to me and said, I've only got a 25% deposit, well, you need 30% because the interest is coming off. So if you have a larger deposit than you think, plus the fees and everything else as well.
And then, because we're just talking all things lending now and getting into the fun part, let's talk development finance. What does that mean? Because I think there's sometimes misconceptions. What is it?
Yeah, I think there is an overlap. So straightforward bridging is bridging to buy a property. You might be doing work to it, but that's going to be funded by yourself. Development finance is if you are developing the property, doing medium to heavy refurbishment. So that could be loft conversions, extensions, new builds, developing on land. But in some lenders might call it development if you're just doing like a HMO conversion and you're paying for it. So I would say anytime you're getting funding for the work, I would class that as development finance.
So that's development finance. So that's them giving you the money for the works. Now I understand that's paid in arrears.
Yes. Okay.
What's the impact of it being paid in arrears?
So it means you have to have on day one, before they give you any money, the deposit and money to start the work off. Now, how much do you need? Kind of up to you. I'd say 20, 25k is a sweet spot. As an example, let's say the work's going to cost 100 grand. You might do £25,000 worth of work.
Yeah.
You send over the invoices. They'll send an asset manager to visit to make sure it's been done to their standard. They sign it off. They give you the money. That takes about 2 weeks or a week. You then basically recycle that again and again and again. Each visit from the asset manager has a fee. That'll be about £400 or £500. So you have to have the deposit plus money to start the work off. You can't even get into the deal.
I think why that's important is because the amount you start off with also determines how quickly you can work. Yeah. Like so my bill cost for my most recent project is around £600,000. Now, while the £600,000 will be completed over 9 months, I know based on, the contract, I'm going to spend 100,000 in month one. Yeah. So I can't start with £50,000 because 2 weeks in, I would need a drawdown facility, and it's not realistic. So I think not just managing how much money you have, but also how quickly you're going to need it. Because when you start early on, starting with those foundations, steels, digging out, whatever the case may be, you have to look at cash flow, and cash flow is what can cripple a development if it's not in place. And
that's why getting a really detailed schedule of works, fixed price contract, project appraisal from your project manager is really important. So the way I explained it there, that's one method, and that's the most common way of getting drawdowns. There are other lenders, not many, what they call a residual valuation. This works on like an S-curve. So let's say you're buying a property to totally rip it out and then build something else. As soon as you start ripping out, the value goes right down. They'll send a valuer out. depending on the current value, they'll give you up to 60 or 65%,
Mm-hmm.
and they keep doing that in stages. It doesn't work on all projects because, again, if you're dropping the value straight away,
if you bought a house and the goal is to demolish it and build flats,
for the first month or 2 months,
you're in negative.
Yeah. So, but some people do that because it can work depending on the curve of the project.
Yeah, no, that's fair enough. Yeah, I find development finance interesting. I think, with a lot of people are kind of sometimes shy away from it, particularly when they look at using investors' money. They think there's less hoops to jump through. But I think it's sort of a case of how experienced are you? Because I think development finance, they do want more experience than just straightforward bridging sometimes.
They want some, it's about positioning. They want you to be credible. So if you could have no experience, but you could be like, look, I'm into property, I've spent this much on my education, my project manager's done 10 of these projects before. You could leverage off your project manager.
Yeah.
Someone has to have the experience.
Okay, and I think that's an important thing that obviously people talk about power teams or what have you, but that's one of the reasons people talk about it, because of the ability to leverage somebody else's experience. You're not expected to be able to do everything, but at a minimum, you're expected to be able to present why you can do everything based on
a
who
CV,
you've got
isn't
around you. Exactly that. Okay, so that's our basic intro into bridging. If you've got any questions, you can ask in the comment section. Hopefully our editor is going to put some amazing visuals on top of the screen. He's going to look up from his phone and see that I'm requesting him to do some amazing visuals to help you out, get those numbers just right. So talking of numbers.
Yes.
BOE. Base rates going up.
Yes.
And up.
Constantly.
However, inflation coming down.
At the time of speaking, yes.
Today, recording on the 19th of July, base rate's going down. This is kind of, I guess, the golden question. But where do you see rates over the next sort of 12 months?
I'm so glad you asked that. No, I'm not. So it's an interesting one. I think rates will stay where they are, to be totally honest. I think what will happen is the fees will drop. So I'm not sure, obviously, people you speak to as well.
Yeah, they're insane.
So there you go.
Like on a 2-year fix. The other day, somebody said, I just want an arrangement fee of like $5,500.
Absolutely. Because they're charging, instead of charging 2%, which is typical normally for a limited company, lenders are now doing like 4-5%. Again, their rationale is, look, by doing that, we can keep the rates slightly lower and get a better stress test, therefore borrow more money. So I think the rates will settle to where they are, but the fees will go back down because they don't need to be so high.
I think, look, like for me personally, there's been a lot of, because you're a property investor yourself.
No? I've got 2 single lets. I wouldn't class that as a...
It's investment. I think I always say
I'm a landlord.
You're a landlord. Well, no, because I think I would still say you're a property investor, not property developer.
Yeah.
But so a lot of people, and I think unfortunately maybe people like yourself are more hit depending on their current gearing when you have like a smaller portfolio or an accidental landlord. Because if you were renting a property, like one of my properties, for example, Croydon used to be a really good earner, was renting it out for £1,100 a month. And my mortgage was around £450, which meant, after fees, after everything, net, still good return. New rates.
Yeah.
It's obviously gone up considerably. That was on a 5-year fixed. All the stuff coming onto a 5-year fixed, you were in a really good place, sort of end of 2018, 2019. Which means, my payments have doubled from pretty much from 450 to 900. It's now pretty much break even. Yeah. Had a few others, that have gone up by £500 here, £500 there. I think across the board, I'm paying probably £2,500 more in interest per month. That being said, because I have a decent portfolio,
you could absorb
rents have gone up. No, but rents have gone up more to the point that some of my HMO rooms that I was getting £600 a month for, I'm now getting 800. So that one property has gone up by 1,000. So there's been that balance of give and take, and I think that's what you get from sort of a little bit of diversification. And
just I think having scale, because I saw in the press a couple of days ago that Lloyds Bank are going to buy 1,000 properties.
I think it's more than that.
More than that. So they want to get into it, so they can they got scale, they can afford to do it, and they can see properties as secure investment. So if you're a newer kind of investor, you got 1 or 2 properties, and they're not cash flowing, you are going to be stuck for a little bit.
Yeah, and I think it's unfortunate, but also it swings and roundabouts. And there's a lot of doom and gloom around the market to say, you can't buy as a new investor. And I say this, let's take the Wells properties, for example, for argument's sake, let's use round numbers, £100,000 purchase price. Now you're buying it, potentially you maybe see growth in there over the long term. Maybe you see some potential opportunity to develop the property and add value, but you're looking at it and saying, you know what? I don't want to buy this property because 2 years ago rates were X and now they're this. So my monthly payments would have gone from being £300 a month to £500. That's £200 more a month. That means over the year, that's going to cost me £2,500. But if you can negotiate £10,000 off the purchase price because other people are scared, you're still in, like, over the next 4 years, you're still in exactly the same position.
Yeah.
And it's where do you think the market's going to be over 4 years? So I think, although there's a lot of doom and gloom people, it's really just get into those spreadsheets, look at the numbers and make it work for you.
Yeah, all about the numbers, and it's a supply and demand game. You know, if there's less buyers, then you're in a favorable position.
Can be a little bit more creative. And obviously it's like, for me, like I've got some stuff on the market at the moment, got some stock, and it's like I maybe wasn't going to get the money I was going to get a year ago or 6 months ago if I would have finished then. And that's unfortunate. But my options are what? I could refinance, leave a lot of money in the deal. I could sell it maybe slightly less than I wanted to, but then I've also now got capital to go again and to buy in the same market. And as long as you're buying at the same time as you're selling and vice versa, generally speaking, you should still be able to negotiate the market and find a deal.
I think so, yeah. And I think the only risk I've got, it's not all doom and gloom. The only risk I'd say for a lot of investors who've got portfolios is this time last year, this time 2 years ago, even the lender stress tests were about 6%. You're paying more than that on a new mortgage right now. So actually your mortgage hasn't even been stress tested at that level. And rents aren't going up as quick as mortgage rates are. But I think we'll see it all balance out at some point.
Today's episode is brought to you by Run Production Studios. They're where we've been recording for the last 15 episodes, and I definitely recommend you check them out. If you want to take your content to the next level, whether that's videography or podcasts, they're the people to check out with high quality customer service and amazing equipment. Their details will be in the description of this video. And I think, look, like in terms of financial services, the property sector underpin the UK economy. So generally speaking, you know, between policy, there is an election coming up. You know, I think there is going to be some, you know, positive, you know, political policy to aid, whether that be something similar to, you know, Help to Buy, whether that be something similar, you know, to the lower, you know, it's the 5% mortgages, for example, and Help to Buy. I think, you know, there is potentially going to be something to aid people in the property space.
I think so, but I mean, there's all these stats obviously out there that this generation are the oldest first-time buyers. Like, people are staying with their parents or renting for longer because it's a deposit. They could probably afford the mortgage, but it's just a deposit so hard to say, especially in London and places like that.
And they did start some schemes, like they started the rent to buy scheme, where effectively you rent for like 3 years and your rent then contributes towards your deposit. But they didn't really make it attractive enough for developers, because you've now got to wait 3 years to exit. So you've really got to be a massive institution and build that into your costings to make that work. So I think it needs to be rejigged, but definitely policy and opportunity could present some options. And I think for the first time buyer market, the other side of it is it's still cheap. If you've got the deposit, which is, I'm not saying it's not hard to get the deposit, it's hard to get the deposit. But if you have the deposit, it's still cheaper to pay a mortgage than it is to rent.
If you had the deposit, would you invest or would you buy your own resi, do you think?
I would always recommend buying my own resi first.
Yeah.
Because buying your own resi is an investment if you buy without the emotional attachment.
Absolutely.
Because if you can buy at 10%, so it means if you buy it, like for argument's sake, we're talking London, so I hope I don't kind of disengage with some people. If you buy a property that's £500,000 and you've got a 10% deposit, well, let's say 250,000, you've got a £25,000 deposit. That means you've got £25,000 and you're controlling an asset worth £250,000. If that property goes up over time, your return on investment is way better. Also, like living there, you know, you're going to make it really nice because it's your home, hopefully. You don't have, if you do sell after a period of time, you're not going to be exposed to capital gains tax. So I think I would personally always recommend buying your own home first.
Yeah.
However, I would caveat to say, like, you know, that it doesn't have to be your forever home. You could buy your own home if circumstances change in a year's time and you say, you know, I actually need a 2-bed now. Then there is options for consent to let and things like that to allow you to move on, and you still own that house. You still put in that amount of money, and potentially it's still going to make you some money whilst you live elsewhere. You don't always have to live where you own as well.
I agree. I think the key thing you said is the emotional attachment. Don't be emotionally attached to that first property because it may not be your forever home. And that's a very interesting. I think the only thing is, again, looking at this time last year, that the difference between a residential mortgage and typically we'd say that's the cheapest kind of borrowing you'd get, 1%, 2% rates. So the difference between that and a buy-to-let mortgage now is non-existent. They're about the same rates anyway. So the cost of the funding has gone up a lot, and now it's not that cheap to get a mortgage, you know?
Yeah, and then obviously the difference between residential and buy-to-let, generally it's repayment versus servicing, so your
Yes.
monthly costs are a lot less. I think, the reality is of any type of investment opportunity, it should be based on your personal circumstances. Always seek the advice, of an expert or of multiple experts. So whether that means looking at taxation and speaking to an accountant, whether that means from a financial perspective, just talking to an FA or a broker and just really understanding what the implication is for you, because you're not expected to know everything.
Yeah.
It's interesting. So outside of property, what have you been up to recently?
I'm everywhere now. I'm at every networking event, every podcast.
Yeah,
Apparently,
I think I last saw you at Savoy's.
saw each other at Savoy's and the kebab you were having.
Oh yeah,
Yeah. It was your birthday, wasn't it? Or was it the birthday
I
part,
saw
celebration?
you in Birmingham. Yeah, so it was my birthday weekend when we was at the.
That was the Steve Hamilton.
Steve Hamilton.
Sorry, yes.
Yeah. I managed to grab myself a great kebab after speaking.
Didn't get to go there in the end.
That's a shame. That.
Yeah.
Do you enjoy the networking side of things? I mean, to do 27 podcasts.
I think you know what it is. I'm a small business. It's me as a one broker. I've got 3 admin staff, and I think I understand I need to be a bit extra with my voice and with my presence and platform, whatever you want to call it, to get clients. End of the day, I could choose to buy leads. I could choose to do SEO and all that kind of stuff. And I could, but the way I do it and the way I enjoy it is meeting people, connecting with people, because eventually I get referrals. I get people coming to me because they've heard me on a podcast or social media, whatever. Those are much stronger clients because half the job is done. Kazi said you speak to you, they trust you. You said you trust me. And that's how it works. So I find that way of lead generation a lot better.
So you've enjoyed the social media side of things in terms of building a business and a brand?
Yes and no, man. Listen, I'm really shy. I am really shy, really anxious.
I say this. You never believe me when I say this.
I do. I think we're kind of similar in that sense. Like I don't like coming on camera. I'm really camera conscious and all this sort of stuff. But end of the day, I treat it like a job. So get up, do it. It's done. If you treat it like a job, it's a lot easier.
And I think when you realize that actually I've got a lot to offer and I do know my stuff, so it's like that first introduction of but once you get past that, if you are struggling with networking, just speak about stuff that you know about.
Can I share my networking tip?
Go for it.
My number 1 networking tip for people who are anxious or new and not sure what to do, right? So let's use the Steve Hamilton event as an example, because they're all on social media. These days, you'll know people who go to the event through social media, like they'll share. Really excited for this event. So you should do what I call pre-networking. I still do it now, right? Is message those people, hey, Jack, I see you going to this event. So am I. What do you do? Have that little conversation, 5 minutes. Do it 5 times. When you get to the event, you'll know 5 people. Straight away, it just makes it so much easier.
I hear you. Have I ever told you the story about my first networking event?
No, go on.
So my old business partner, he was very pro networking. He worked for PIN.
Okay.
Worked with the PIN group and was like, look, we got to start going to more networking events. We got to get out there. We got to build a brand, starting a business. So, all right, no problem. I'm going to go. Because we committed to go to 2 a month. First one I went to was like, again, different type of networking event. Very white middle class event.
Of course, PIN is,
Yeah, I was there. I was in there, in my suit, whatever. And I'd been in property at this point for maybe 5 years. Like, I knew my stuff. But like, no one really approached it. I ended up speaking to one person all night, and that was the guy who worked at the bar because he was a black guy in the room. Didn't speak to anybody else. And obviously that's bad, but it was like, I went there, but the thing is, and I failed at that attempt at networking, but I still went again.
Do you think you failed, or were you prejudged because of what you... Well, no, you were dressed in a suit, so maybe...
Yeah, I think it was just more one of those, I had that imposter syndrome. I didn't feel like I deserved to be there. But it's then going to it again, and it's like people are like, oh, what are you up to? And they're kind of like, well, I do this and I do that. And you're saying, oh, okay, yeah, I've done a bit of that as well and done a bit of this, and now I'm doing that.
Yeah.
And I think people often underestimate. And I think for me, a tip for networking was, it's hard because I'm not that confident myself naturally, but be confident in what you know you can do. A lot of people, particularly in networking events where they know there's a lot of Johnny Big Bollocks in the room, like get a bit shy. But don't ever lead with I only. I meet so many estate agents, so when they come, like, oh, come to this networking event with me. And then when I say, oh, this is like my friend Daniel, and they're like, oh, what do you do? He's like, oh, I'm only an estate agent. It's like, no, I'm an estate agent with 10 years experience. I've sold over like 30 million pounds worth of property and I want to do X. And I think it's just having that lead and that introduction to yourself of confidence. Like, it helps other people
confidence. It's an exchange of energy, isn't it? And I think another tip as well is the role I adopt, right? Sometimes, because I'm even now, 4 or 5 years in, I'm still sometimes some events I'm like, is the role I'll take up is being the connector. So I'll speak to someone, hey, I'm here to speak to an accountant. You should speak to so and so. leave them together, start another conversation. It just eases a burden of me having to have a chat. Do you know
Yeah,
what I mean?
and it's just like just introductions. Like if you know who certain people are,
Yeah.
and also you've been there before where you don't know as many people, you don't feel as confident. You know, it's always going
But
to
just
help.
be consistent. Again, some new people, like, they go to one event or two events, so 2 months, and nothing's happened. I'm not gonna go. Not gonna happen. No one's walking around with a mortgage deal. Do you know what I mean? You got to go consistently. You get known as that person that does X, and also I think that there is some merit in going to events that are not mortgage property related.
Yeah, definitely.
Because you'll be the only
100%.
person that does what you do. So
Exactly. Like I went to an event like with the BBC, and it was like I was in there like, why am I in here? Like this is so random. Like even the person who brought me there was like, what? Like how do you introduce yourself? And I was like, I just tell people I do property. They're like, no, tell them you're a content creator in the
That's
property
it.
space and X,
Yes.
Y, or Z. And then when I started saying, and then I started speaking to, and I met an investor there that I work with now. Like he's a GP, he wants to introduce me to other people. But definitely go into non-property based networking events. I think is a good key as well.
But you know what? I try and I call it like a triple threat. I do try and mix in networking, physical, with online, with the whole social media thing. I think for me that's been working really well. I'll DM people without any kind of fear of rejection now, because it's how you do the DM, it's how you open the conversation. So instead of "Hey Kazi, how are you?" it's like, "Hey Kazi, love your content, love the energy. What is it that you do?" And just have a good, approachable conversation.
Yeah, no, I think that's good. That's
Obviously,
good.
you never reply, but you know.
I do reply. I reply to it. Listen, one thing you
joking.
don't know is that
I'm
I
joking.
reply. I was out on this is where she ever sees this. I was out on Sunday, like a friend's event, and then this lady came up to me and was just like, "I just want to say thank you," and I was like, "Oh, no problem. What did I do?" She was like, "Oh, like you know what? You just actually spoke to me. Like I DM'd you about like my parents like needing to go into care, and I wanted to create a multi-generational home, and you asked to speak, and you just said, look, I'll give you 15 minutes. Like I'll call you now if you're free." And she said you spoke to me and you spoke free. So I couldn't take the advice, but I proper appreciated that you took the time. And obviously that didn't come to anything for me. I wasn't like a win for me, but it's like some of those small conversations that you just think, oh, let me just help somebody out. You don't really know where it's going to go. And that's the whole thing about networking and staying proactive. Like you don't just get lucky. You don't just do everything for a return, but by being busy, you create opportunity.
Yeah, I think there is obviously everything's transactional to a certain degree, but you got to play the long game and bigger picture thinking, isn't it?
Definitely. So what kind of deals are you seeing being done at the moment? Like you said, you're still quite proactive.
Yeah. I mean, look, we've seen a slowdown now in purchases for term mortgages, but a lot more bridging, a lot more short-term finance, people doing projects. One, because there is the deals available because no one else is buying. And two, because I guess they're hedging their bets on rates perhaps going down in 6, 9, 12 months. So a lot of bridging, a lot of development, a lot of commercial conversions. The purchases that we're doing are a lot more short-term finance, like service accommodation, holiday lets. Because I guess in terms of that strategy, the cash flow is still there, isn't it?
Yeah. No, definitely. And do you think, like at the moment, I guess in Wales it would still work, like 75% loan to value still works because the rent versus the mortgage payments still work. Whereas when we look at what you could lend 2 years ago, based on, based on rental income of £1,000 versus now, it's dropped massively. So I think when we're exiting, if you're exiting to retain now, you've really got to, when I speak to larger institutional investors, they're stress testing it like sort of 65% at a top end on a realistic exit. But I think working in a area where the purchase prices are a lot cheaper, I guess you can still work at...
Still works, and the option's always there to go for a 5-year fixed. The stress test is more sympathetic. Often doing that can get you between 70 and 75%. So yeah, again, large deals, they'll struggle perhaps to get the 75, but if you've got things to pay off, like a bridging loan or an investor, it's something you might have to do.
Okay, going to ask you some questions now. Quick fire.
Go on.
Who is your favorite, outside of myself,
Okay.
property influencer?
Ooh, property influencer.
Quick.
Who do I like? Okay, I'm not going to include Tej because we're too close.
Okay.
He's my boy.
Oh, come on, this is not quick. This is not quick fire.
You know what I like? Tyler Newman. There you go.
Tyler Newman. Okay, Tyler Newman.
The guy just reeks luxury and sophistication, and he's very polite.
Okay. Who do you see, like in the property space, who do you think is most likely to get to, let's say a big number, 100 million?
Okay, so I'm not including you in this again. Alfred Zadeh.
Alfred, yeah.
Yeah.
Alfred, he'll love that as well. Alfred, but you know the funny thing about Alfred? If you tell Alfred, I think you're going to get to 100 million, Alfred will say that's not enough.
Light work.
That's easy. I want to get to 1 billion. And I hear it from him, man, because one thing he does say, and I've repeated it recently, is like, you know, there, out of everything, there is more money in this world than anything else. Yeah. And it's not just a case of, is there money out there? It's just, can you do what you need to do to attract it? But he is relentless.
You know, I've done some deals with him where it's a week before completion. I'm like, Alfred, you know, you're still short of 200 grand. The next thing I see, he's on Instagram going, I need 250 grand. Don't message me if you're scared of losing your money. Don't, you know, I need serious people. And he does it.
Yeah, no, he does. And I think that's it. Like, you attract the energy, put you out there. Like, I had a conversation with once, and I was like, Alfred, like, sometimes you don't, like, you come across a bit whatever, because I always give people honest feedback. And his thing was, look, I don't care. They're not the people I'm trying to attract. And that's fair enough. And it works for him. And he's done really well. So congratulations to Alfred. Another guy I really like is Luigi. Have you come across Luigi?
Yes, Luigi. Yeah,
Luigi's done really well. Like, I think when I met Luigi and I interviewed him on this podcast, probably I want to say about 18 months ago, I think he was on his 6th HMO. I think he's now on the 17th, 18th.
Yeah.
So he is, in terms of like in 18 months, doing sort of close to 10 deals.
And he's not someone who goes on and on about it on socials. Like, he obviously talks about his journey, but it's not bragging about numbers, you know.
Yeah, no, he's good. And then I really like the two young boys, Aaron and Ethan.
Yes.
Yeah, like they're sort of 23,
smashing
doing it. Like, both of them are doing how many figures? I always get this 7-figure deals at the moment.
Mad.
At that age, and I think they're ones to watch out for. Whose content do you enjoy watching the most?
And in the non-property space or property? Okay,
property,
so listen.
Keep it property,
I'm going to get into. It's a sales trainer, so I get into things a lot. It's my personality, right? So I stumbled upon this guy called Daniel G.
Okay.
Now he's from Canada. He's like a young 26-year-old Italian with the hand movement. And he just talks about sales in a way that I'm like.
So you're doing it now. You're emulating.
In a way that I want to see more and more of this content. Sales is a exchange of energy. You know, he's like, opening's easier than closing. If you can't open well, you're screwed. And I'll share some links for you now. The guy's sick. He's insane.
Yeah. Like, whenever I think about opening, I always think about, do you know the beginning of Wolf of Wall Street, when Leonardo DiCaprio first goes into like selling the penny stocks, and he's in there and he starts on the phone and he's just talking. Before you know it, every person in the office is looking at him. You're like, that's an opener.
That's the energy you want.
Yeah, that's what you need. That's what you need. So you said you got a bit of a love-hate relationship with the social media side of things.
It's not a love. I mean, it's love-hate. I think it serves me. You know, it generates me money, business, all that kind of stuff. I think I'm quite fortunate. I haven't put any pressure on myself. Like, I'm not doing a weekly Wednesday wrap up. There's no time that I have to be online every single week. I post when I want. I'll have some weeks where I'll post 4 different videos, and I'll go months without posting anything, and that works for me. So yeah, I've not put any pressure on myself. But then sometimes I think, if I put more effort in, could I get more returns? But then, do I want to be more busy? Like,
it's a balance. Like, 'cause look, I love property. I honestly don't love social media. Like, I love the fact that I can put property on social media, but I don't love having to do it as a job. It doesn't come naturally.
It is
to
a
me.
job. That's a good.
And that's the thing. It is a job, and I think finding that balance. And I think that's where sometimes I think I've had to learn to be like, okay, let me delegate. Let me get somebody who's going to do it, so I can do what I enjoy. I can just go out there. Like, so I enjoy these. I love these conversations. I love talking to people. Love hearing about people's successes, what they're up to, what they're doing. People educating me. But I don't want to sit there editing. I don't want to sit there having to work out a thumbnail, a title, a description, when to post. So I try and delegate to make it.
Well, that makes it easier for you. But I'm quite techie, so I enjoy that stuff.
Oh yeah.
But I heard there's a real estate agent from America, Ryan Sehant, the guy in the suits with white hair, and he was on stage and he said, look, anyone can broker a house. It's quite easy. But what isn't easy is building a personal brand. So he goes, that's why I wake up and do what I do. This is my personal brand, and that's why I get the clients all day long. Eventually, without trying, because the brand is there, people know who you are and resonate with you. So I think treat it like a job, which is a very, very good thing.
Yeah, no, it is. I think it's just a case of finding that balance, that work-life balance. That's definitely the case. So what, you're not going to get tempted. You're not going to get tempted to dive into the developer world. You don't see all these projects and think, oh, I want to do one of those.
Yes, and I'm too busy in my business. Right now, I'm in my business. I'm not working on my business. I'm in my business. I think once I grow the team out, get more brokers, more salespeople, potentially then. I have joined, and by the time this comes out, it'll be, I have joined Deload Lowe's 5 D Club. So business acquisitions and things like that. Now, do I want to buy a business? Not specifically, but I want to learn something different, something new set of skills. we'll see what happens.
And it's also a lot of the time people don't realize how transferable skills are. So even if you don't end up buying a business, it may be something that you can implement within your own business as well. It's nice. So that means I'm going to see you on a jet soon.
A private jet, yeah, of course.
Yeah. You're living, man. You're living life. You're enjoying.
Look on a Virgin Red Letter days and just book an experience.
Just a quick one. I hear that. And what do you do like outside of property? What do you like to do?
I do like to go to the gym. However, I've hurt my shoulder. I've got 12 weeks worth of rehab and physio. So that's a pain in the backside. Just downtime. Isn't really a thing. Because people say to me, if you're traveling so much, you're at these events, when do you find time to do work? I kind of make the time. So the time that I'm not doing all this traveling is I'm on my laptop, getting the deals done and working the numbers. So sounds quite boring, but I enjoy that.
That's the main thing.
Self-development.
As long as you enjoy it, do self-development.
Yeah.
That's good. All right, then. Well, it's been an amazing episode. Appreciate you coming all the way down here. I'm sure the guests do.
From Wales, international guest. Can we
listen,
just acknowledge?
We're an international podcast. We're not just one country. You know, we see our Spotify, Apple Podcasts. We're global now, man. We got global guests.
Hit that like and subscribe button.
Of course. This is what I say. Does your job, does my job, I should say, for me. This has been another episode of the Property by Kazi podcast. If you've enjoyed this episode, make sure you like it. Make sure you subscribe to the channel to get the notifications each and every week of another amazing guest. Take care.